Good morning, everybody. It is Friday, June 4th, 2021. This is Kirk Spano with Investment 2020s, writing over at Seeking Alpha, at Substack, at Medium. And today, I'd like to invite you to meet me in Las Vegas. And I'm doing that via my core website, which is Fundamental Trends, that I will go through with you for just a second as I let the questions load up. Today is going to be a Q&A day. So ask me any question you'd like that has to do with the economy, macro issues, sector-based, industry-based, the future of energy, particular nations, ETFs, and we'll try to buzz through those. There'll be some brief pauses as I look things up, but then I'll edit those out for the YouTube broadcast. So hopefully you have some questions, but if you would like to meet me, I will be in fabulous downtown Las Vegas in just a few weeks. Friday, June 25th, I'll broadcast from the Golden Nugget. And then anybody who wants to show up, I'll buy you breakfast. Unless a lot of you show up, and then we'll figure something out. I'm just kidding. I'll buy breakfast. Golden Nugget has a couple of restaurants. I have to talk to them, figure out which one to be in, but I'll post that the day before. I'll also be in Las Vegas in July and in October and in January and probably in March and then again next June. So I will be doing a lot of meetups in Vegas so that you can come on out and meet up with me. So made a lot of updates to Fundamental Trends this week. Just like to say, if you're not a member, you should be. This is some of the things that members are talking about. Have different options for everybody. I would say if you are a swing trader, you're going to want rare investing and you want some micro caps, but otherwise sustainable growth investing if you're younger and looking for growth. If you are retired, retirement income options or dividend collector, basically dividend collector if you don't trade options, sell options, covered calls, cash secured puts. And if you do want to sell cash secured puts and covered calls, retirement income options. And in order, these all include the recommendations from the services that are less expensive. So rare investing includes everything here. Retirement income options includes everything here. Dividend collector is everything here. Sustainable growth, everything there. And then global trends ETF, which honestly is a great service. That one article a week is worth its weight in gold for people who are just looking to asset allocate, and you can apply the ideas to your 401k. Content, awful lot of it. A lot of it's free. What I've done is I've released some old articles. So some of these articles that a few weeks ago were only for paid members are available with the free library card. So I encourage you to get the free library card because a lot of the content is available to you on a time delay. And then for the members, these are the articles that just went up this week. I think we have pretty good content here. And what I will say is that I look at investing a lot different than other people. I try to be as Warren Buffett-esque as I can. Which means that I'm missing horribly. But I look at companies based on the businesses that they do and how successful I think those businesses will be over time. And if my analysis is different than the market, then I have to decide who's right, the market or me. What I can tell you, and I'll use a couple of examples. I'll use Ford and AT&T as examples. 3.5 years ago, when AT&T acquired Warner, I told everybody that, hey, Warner is an appreciating asset and they'll monetize it at some point, either through subscriptions or making a deal. Because I anticipated consolidation in the streaming space years ago, and now it's happening today. The next big deal you're going to see probably has to do with Viacom. I really think Comcast is likely to come to the conclusion that they should spin off NBC. And it makes sense to me that CBS and NBC and all the other Viacom assets merge. I can see AMC and some of the little players combining as well, or getting bought up by Amazon, which just bought MGM. But AT&T, everybody wants to talk about how a failed deal the Warner Brothers thing was, and it wasn't. The Warner Brothers deal is turning out to be a good deal. Now, did they know exactly how to do it on their own? No, but I think that they were just looking to take the customers and then flip the asset anyway. They tried the same thing with DirecTV, and it didn't quite work out as well. But even when they flipped that off to a private equity firm, it's probably not going to be a bad deal in the long run. So everybody tries to judge these deals based on, oh, look how it did in the first year. Well, no. When something that big happens, you have to take a look at how it's going to play out over a number of years. And now, 3 years after I said it would happen, what happened with AT&T? They spun off Warner, and now it's merging with Discovery, and you have Warner Brothers Discovery. I was close on what the name would be. I thought it'd be called Warner Discovery. They decided to keep the brothers in there, so Warner Brothers Discovery. I think that's a lot to say. I think Warner Discovery would have been the better name, but again, they didn't call me. I knew how those operated, how those businesses operated. That's where my analysis is different than most of the guys on Seeking Alpha and Investor Place and Weiss and everywhere else that puts out an investment letter. They just look at what the other analysts are saying and say, well, a whole bunch of analysts say that this is what's probably going to happen. So, hey, that must be right. It's an echo chamber. And I rail on the echo chamber in finance all the time. And it's not recent that I've been doing this. I've been railing on the echo chamber in financial press for over 20 years. It didn't take me but 5 years at the start of my career to figure out that most of the financial press that you see is bullshit. It really is just bullshit. They're just regurgitating things that they have read, that is regurgitation of some things that other people read, which is regurgitation of other things that other people read. And it's like this big circle. You know, the one where you play the game and the first person says peanuts, the next person says peanuts, okay, and they repeat it, and the next person says peas and nuts, and they say that to the next person, and by the time you get it all around, it's just pistachios. How they get from peanuts to pistachios, I don't know, but that's how it ends up. And most of the financial press out there is just so astoundingly bad. The investment letters are so astoundingly bad that you'd almost be better off just indexing and picking out your 12 favorite stocks. And that's not a joke. I saw an article this week about AT&T. And in the article, it said you should buy British Tobacco, Enbridge, and Prudential. And I pointed out that 2 of those 3 businesses are in secular decline. And I got argued with about that. That's part of our process. Our 4-step process is pretty simple. You take a look at the secular trends, and you bet on the secular trend, not against it. Why? Because secular trends are long-term things that don't change quickly. So when I say you want to lean towards clean energy and dump all your fossil fuel stocks with like just a handful of exceptions, it's because the big secular trend is towards clean energy and away from fossil fuels. Now, does that mean it's going to happen tomorrow? No, it doesn't mean that it's going to happen tomorrow. But it's going to happen over time, and it's consistently going to happen. And there are going to be elevator drops with the fossil fuels. And there are going to be rallies in clean energy that are so huge that they can be life-changing for you. So when I see a secular trend, one of which was the move from cable systems and a zillion different channels, so to speak, to streaming, I knew that there'd be a lot of entrance into the space, and then they'd consolidate down to something that was very profitable. And AT&T acquiring Warner Brothers and all that content, including HBO studios, even though some of the people got away because they didn't know exactly what to do with it, was a good deal. So all these people writing about AT&T saying the Warner Brothers deal is a horrible deal, they're wrong. They're just flat out wrong. And I understand that the dividences want to run around and say, oh, they cut my dividend. They're going to cut my dividend. You know what? But it'll be more secure. Business will do better. They have avenues to grow the business again because they're reducing debt. And by the way, they're already saying that probably in 2023, they're going to start buying back shares, which means the share price will go up. And you know what? You know what? If you really need the money, sell 1% of your holdings, right? You could do that for 100 years before you'd be out. You're better off with small dividends, big piles of cash at the companies, a lot of free cash flow, and then buybacks when they can do them. That's where you're better off. So when I hear people talk about, and this is kind of a point that I was getting to, when I hear about people saying, well, I live on my dividends. You know what? That is just such a piss poor way of investing that I want to scold you significantly. I mean, what I want to say, I can't say. But if you're telling me that your primary motive as an investor is to generate income through dividends, I just don't know what you're doing. Because stocks, no matter what they are, every single stock in the market, there's not an exception. And the only one that comes close, probably Berkshire, maybe I guess Apple, as bond substitutes. There aren't any stocks out there that you should be comparing with the income that you get from bonds. We're in a day and age where interest rates are low. They're going to stay low because inflation that's going on right now is a one-off, not due to Fed policy, but due to supply chain disruptions. And those supply chain disruptions are actually hugely good for American business. Again, in the intermediate term and the long term. And the next year or two might be uncomfortable because there's change and people hate change. Well, change is constant. It's the only thing that doesn't change is that there's always change. So I want you to get out of your comfort zone sometimes and get off the whole notion of, well, I buy stocks for dividend. Again, bullshit. The average dividend yield of the S&P 500 is 2%. 2%. It's basically same as a 20-year treasury, give or take. If you can get that type of a dividend versus a treasury, 20-year treasury, why wouldn't you buy the treasury? There's no risk of default. And again, I know there's no risk of appreciation either, right? Maybe your stock will go up if you own the stock. Yeah, well, maybe it'll go down. 1/3 of stocks over a 30-year period will go to zero. That rolling time period is going back to about World War I. I forget which year it was exactly. So if you have a 1/3 chance of your stock going down the elevator shaft over the course of your lifetime, why would you tell me that the most important thing is the dividend? That is not the most important thing. The most important thing is that the company is going to be healthy and profitable long term. So all these crybabies who say that, well, AT&T is betraying me by lowering their dividend, once again, I call bullshit on you. Because what was going to happen with AT&T if they stayed on the track they were on, rather than flipping the asset and resetting the dividend, was at some point the company was going to get in trouble. And I don't know if that was 5 years down the road or 10 years down the road. I don't know when that would have been. But why would you want an unhealthy AT&T versus a healthy AT&T? Oh, because I was getting 3% more in payout. Yeah, but the stock price hasn't gone up in 20 years. In which case, you should have just bought the AT&T bonds. See what I'm saying here? You are safer with a bond. And all things being equal, if the stock's not going to go up because it's unhealthy, because the market doesn't like what it's doing, why would you own it for the dividend? You're not getting the appreciation, and you're further down the claim chain if they would have had to go through a bankruptcy to reorganize. So by spinning off Warner Brothers into Discovery, you, the shareholder, continue to get around a 4% dividend from AT&T starting sometime next year. from these prices, and you get a ton of your dividends pulled forward. Because when you get that discovery stock, if you really want the income, you sell it. And that's going to amount to several years worth of dividends at least, maybe a decade's worth. So you're complaining about the dividend rate going down in the face of potentially being able to pull 10 years or 12 years or many, many years worth of dividends forward to today that you can reinvest or whatever it is you want to do. So I want you to understand my philosophy, which I talk about in the Getting Started articles. So if you haven't read this, and I update it once in a while, you should read it because this works. And I know that sometimes it doesn't look like it works, but over the long run, it's made me pretty well off. And I'm just standing on the shoulders of giants. Because what I'm telling you is that if you bet on the secular trends, you understand what the government and central banks are doing, you understand the fundamentals of the businesses themselves, the industries and the businesses within the industries, and then you apply very basic technical analysis, right? That's the 4-step process. Bet on the secular trends, understand where the government and the central banks are accelerating or decelerating things or changing the direction a little bit. But usually the government and central banks, all they really are doing is changing timelines by sometimes being a little tight, sometimes being a little loose. Take a look to see if the industries are healthy. And here's an example, the gold miners. The gold miners basically went through 7 or 8 years of cleaning up their businesses and their balance sheets, getting rid of extraneous assets that weren't profitable, that were high risk, focusing on their best assets, and cleaning up their balance sheets for 7 or 8 years. So now the industry is healthy, and at higher gold prices and higher silver prices and higher copper prices, their margins went from 15 or 20% to 40, 50, 60%. And they're just throwing off money. They're raising their dividends and they're buying back shares. So when you see an industry do that, be down on itself for a while as they reorganize across the board, you have to ask yourself a question. Do they have a heck of a rally coming? And the gold stocks are one of those places. So with gold stocks, somebody asks, how much of a percentage should I have there? Well, it depends on what type of investor you are. With gold stocks, and let's take a look at the chart here. Here's the chart for the VanEck Gold Miners ETF. Chopped along. Fell during the financial crisis like everything else. And then because people started running around saying they're printing money, they're printing money, they're printing money, the gold miners went up. And the price of gold spiked to 1900, which was 12 years after it had been 300. So in 2000, the price of gold was like $300 an ounce. I mean, 1999. Down to 1900 here. And the companies started opening up mines that weren't that profitable. So as the dollar strengthened and the Federal Reserve tapered, these companies were stuck with bad assets. Not so much tied to the price of gold, which did come down to about $1,000 an ounce, which is about what it costs to produce the gold, is that the companies got fat on expansion. Same way the fracking industry did. And they had to tighten their belts. The difference between gold and fossil fuels, of course, is that fossil fuels have a secular trend down, and gold's probably neutral to slightly up. So when this crashed, all these companies for years started closing their bad projects, taking their charges, cleaning out their balance sheets. And they came into the last few years. Remember, I said there'd be a gigantic rally in these stocks before the pandemic. That article and those webinars are out there. And here's what it's done since. I mean, this is a pretty good rally here, right? It's volatile. pandemic. Oh my God, they're printing money. People take a deep breath. And this hit exactly, right? I've had these boxes drawn for how long now? Very long time. And it hit exactly where I said it was going to hit. We've gone a little lower, and pessimism in markets and sentiment can always drive it lower. So 2015 and 16, when the Fed was tapering and liquidity started to fall, you got that 2 years period of choppy markets, which seems to be what we're in now. So how will this work? Well, probably you get chop here and chop and chop and chop. Now the question is will GDX get to 50-ish in the next few years? Will it go even higher? I suspect it actually makes a run at 100. So we're not really going to talk too much about stocks, but I wanted to use AT&T and Ford as examples. Take a look at Ford. Going back a very long time. They had a spike in 1999 just like everybody else. So just chop that off. Say, okay, look where it is now. Here, 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 and here. 1, 2, 3, 4. Ha, 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 ha. Now they're going to pull back a little bit because that's what it does when it hits resistance. 1, 2, 3, 4. Resistance. Didn't go through it, didn't go through it, didn't go through it. The only time it went through it was during the stupid 1999 rally. So now you're going to pull back, and then it's going to finally go through resistance. Before we get to $50 a share, I don't think is that big of a get. So somebody asks, is it too late to buy Ford? No, but I think the thing to do is buy a little bit on a down day if you're not already in, and then sell some cash secured puts. And if you don't know how to sell cash secured puts yet, use this one to learn. Sell your cash secured put at the money, so $15 or $16 a share for September. I have sold puts on Ford for September at $11, $14, and $17 at different times, different pullbacks. Option selling is so remarkably profitable on growth stocks. Right? Everybody wants to buy calls or speculate on a collapse and try to divine themselves into being a superstar trader without really even knowing how things work. And I see this all the time. Those people are asking me about trades, and I will tell them why I'm doing something. And I can hear it in their voice and see it in their eyes. They have no idea why I did it, what the step-by-step process was. They just want to know the trade. Just tell me the trade. And because about half of swing trades don't work out, they go, I don't know why I don't listen to you. Well, it's because on a swing trade, you're only trying to win 50 to 60% of the time. And I say trying because, you're trying to win them all. But swing traders are never going to do any better than about 60-40. None of them do. The thing is you let your winners run and you cut your losers quickly. And that's how you win on swing trades. Say 40% are small losses, 40% are probably break even, but 20% of them are really big winners that offset the losses and then make you some money. And every so often you have that one that goes up 3, 4, 5, 600% in a month or two. Granted, it's probably only 1% of your portfolio, but you just drop 3, 4, 5, 6 points. Your bottom line for the year. And I will tell you that on the trading side, if you don't have a consistent way of approaching it, you're going to lose. So even though I got a big oil trade wrong, 2 of them actually, didn't much matter. So I scaled in and I scaled out, and I scaled out faster than I scaled in. So all these things play in together. How did I know Ford, when it was down in here, and especially down in here, I told everybody double up. I mean, how many times did I talk about Ford in a webinar? And because it was in this sideways trend after a downtrend, people are like, Ford, just Ford. I tried to explain the business model, why they dump sedans, why they're moving to EVs, how brand loyalty was going to help them, right? But there was more than that, right? Their fourth industrial revolution technology was so good. I was like, these guys are going to be able to pivot into all sorts of different businesses. When did I say that? I said that from the CES in Vegas that I was at last January. 4 months later, they were making ventilators. So it took them all of 2 weeks to reprogram their robots. Robots that have been making cars were now making ventilators. They needed a partner to get all the software ideas and reprogram their machines. But wait, there's more with Ford. They own a ton of real estate. And at some point, Ford is going to spin off that real estate into a REIT. Why would they do a REIT? A, the tax advantages, and B, because Ford will still be a major owner, and they'll collect all those dividends. It makes sense for them to do it. And with supply chains moving back to America, because we've had enough of the commies, during this transition, certain types of real estate are going to do really well. We have a REIT that takes old, broken down warehouses and industrial buildings and converts them back to class 1, right? Level 2 and 3 markets, turn them into projects, right? Rehabbing. And why I told you about real estate, because it's a place I invest, is you make money in real estate on the redevelopment, not on the rents. When you can take a piece of real estate for 50 cents and turn it back into $1, that's where the big money is made. And sure, it's nice to collect that 5, 6, 7, 8% dividend. That's how they get you to buy the shares. That's not where the real money is. I could double my money and collect the dividend. Or I can just collect the dividend because I bought late. Oh, look, it went up for 5 years. I guess I'll buy it now. No. Understand what's going on with the companies that you own. Do you want to buy the dips here on Ford? Yes. And remember what else I said about Ford. If the Reddit army decides that they love it, they can shoot the thing straight up. Hey, we'll have to manage that. Oh no, I'm going to have to trim it on the way up. Break my heart. When I take profits, it's because I made 50% or more generally. Every now and then I'll take a 30 or 40% profit. And I'm not investing in companies to do that. Because I know that the big money isn't from here to here. The big money is from here to here. So because I and a lot of you bought Ford at, I think as low as $4 for a 4 handle, and 5 and 6 and 7 and 8 and 9, a lot of you are going to end up probably with a 5 or 10 bagger here because it'll set new highs eventually. It took 20 years, 25 years, but understand business. GM doesn't have the real estate or quite as good a technology as Ford. Just doesn't. And as good of a CEO as Mary Barra is, and I do believe that, nothing shows me different. GM just has a different set of problems that will be harder for them to overcome than Ford. So all the problems that GM has, Ford has the light version of those problems. Same problems, less filling. That's just some things to think about. So people are asking, what about cryptocurrency? So let's go back up here. And actually, I just want to show you some things. You know that I read Bloomberg, I read The Economist, I read the New York Times. I'll tell you, for $1 a week or whatever the special is on New York Times, just reading Paul Krugman will make you smarter. Wall Street Journal. Somebody asked about the jobs. I think that the United States will be at full employment within the next 2 years, and it could be sooner. Depends how fast we get the infrastructure projects running. But I think that we are at full employment by the summer of 2023, and it might even happen by summer of 2022. I'm not positive. Unemployment rate's down at 5.8%, but don't buy that. You have to remember, there's a lot of people out of the workforce right now. So I'll show you some different numbers at a different time, maybe next week. We have to get the labor participation rate up as well. So for us really to be at full employment, because of labor participation rate being low, the jobless rate would actually have to fall to a slightly negative number if you netted it all out. So we need 6 or 7 or 8% more of the population to work. And half of them are going to filter in this summer, and the rest will be over the next year or two. So we're going to go back to full employment. It's going to happen pretty quick. This is going to be a much faster rebound than the Great Recession, which was structural from a financial standpoint. This was a shock. Unless we get shocked again, we might not have a recession until the second half of this decade. In fact, I would go on record as saying I don't think we're going to have a recession until the second half of this decade. 2025, 6, 7, 8, somewhere in there. Now, will the growth be lower in the next several years than it was this year and will be next year? Probably. And again, it has to do with the rebound off of the shock bottom. So how does that play into inflation? Somebody asks. I think the word transitory is a tough one to define. I think that the Federal Reserve isn't quite as easy to interpret as you'd like them to be. No, I'm not sure what's going on. In any case, the Federal Reserve isn't always easy to interpret, right? Some of the Fed governors are saying that they can't cut $120 billion a month. And you have the bond vigilantes and the crypto anarchists and everybody else. Oh my God, the debt. Do you know who said that doesn't matter? Maybe remember that from 40 years ago. What shadow president, it's a hint, what shadow president said that doesn't matter? That's right, it was Dick Cheney. And why did he say it? That's the more important thing. Not is he right or wrong, because 40 years of history show that he's right, at least for that portion of history. But why did Dick Cheney say that doesn't matter? It's because the inherent advantages of the U.S. economy and geography and overall system and military and global diplomatic apparatus and intelligence, technology, workforce, the United States has such a huge economic advantage on the rest of the world. Our baby boom at least had a shadow boom, echo boom. Our demographic problems aren't as bad as Japan, China, or Europe, or even some emerging markets. Nobody's going to really ever attack us. Best they can do is shut down a pipeline for 4 days. And frankly, if we ever go on the offensive with cyber attacks, which I think is about to happen, they'll just start leaving us alone. Because given that we own 2 of the largest fiber networks in the world, what would it take for us just to turn off Russia's internet? Well, I'm here to tell you it won't take much. We can do it to China too. So when you take a look at all the advantages of the US economy, the technology, everything else, the geography in particular, we've got the best piece of rock on the planet. Right, in the oil industry, as they call it, your rock. The United States is the best rock on the planet. You know, and by luck and determination, we kept it in as one country. And hopefully we're not stupid and start breaking it up, because that would be the death of a lot of us, especially financially. That doesn't matter that much because the dollar is vastly undervalued, vastly undervalued. We take on all this debt to keep the dollar from exploding in value. So what does the next piece of history portend? In a day and age where machine learning makes keeping a currency low less important for export purposes, the dollar is going to start going up again next year or 2 or 3. Now, does that mean it can't fall down into here? It doesn't mean that at all. Huge support in here, though. I've been saying for quite a while that we get a double bottom here, and I guess right around here. Remember when I told you when Biden won, it probably marked a near bottom in the dollar? And rallied right after he won. It's going to rally again. Now, will it get down into here or here? It's hard to know. When the Fed starts to taper, when the economy really is on firmer footing, they'll turn off the inflation spigot, which they're running right now, and the dollar will get stronger. And just like magic, the inflation will go away. Even better than that pandemic did a year ago, right? The pandemic went away magically a year ago, didn't it? Anyway, but couldn't help myself. If you believe anything about the economy, globally or locally or anything else, believe this. The United States economy is so strong compared to everybody else. I mean, relatively speaking, it's not really even close. And think about China with 5 times more people, and they finally have the same GDP as us. And their GDP per capita is, 1/5. And if you like to live on 1/5 the money that you're living on, think of it in those terms. This is the Goldilocks zone for the dollar. If the dollar chops along in here for a long period of time, that would be spectacular. But what I expect, now that we've pulled forward so much helicopter money that I said a few years ago was coming to bail out the retirement system and all the other things, we're basically bailing out all the other things now. So all that's left is to bail out the retirement system, and that's coming. And we'll probably do that when the dollar starts to get a little too strong. And we're like, okay, dollar is getting so strong that it's ruining other economies. So let's pull it back down. Let's bail out our retirement system and print $20 trillion. Because you'll see, we spent a couple $1 trillion to get out of the financial crisis. Started to unwind it a little bit. Then the repo market went bad. And we printed $1 trillion, almost. Then the pandemic hit, so we print two more trillion. We printed another $1.5 trillion. How many trillions can we print? The answer is pretty many. And again, it's not technically printing because you are creating a debit on the other side of the ledger. This is debt. It has to be resolved at some point, theoretically. As Dick Cheney has pointed out to us, maybe not. At least maybe not for a very long time. I have some ideas about economically how this will play out. It's going to take a long time. It's not that important to us as investors, to be real honest with you. What the Fed is doing will help you understand the trends. So when they stopped printing money here, this is also when the stock market leveled off, right? Then it started to run into some problems at the end of 2019. And we can't have a reset going into an election year. So they printed money to avoid a correction going into 2020. But then the pandemic hit. Now, this area here where they printed the money from September 2019 to February 2020, they didn't need to do that. The repo market would have worked its way out. There may have been a very shallow recession. I suggested, what did I call it? A skip straight recession. Basically a series of bad first quarters and every now and then a bad quarter. And in fact, the first quarter of 2020 was on its way to being like a zero growth quarter even before the pandemic, while the numbers had peaked out. So your crypto anarchists and all your Bitcoin people point to this and say, this is why you got to own Bitcoin. Not really. Because Bitcoin has no intrinsic value, right? Gold has intrinsic value. We use it for stuff. Jewelry, there's industrial purposes now in the high-tech world. Same thing with silver, with clean energy. Gold is actually used in some clean energy. Apple owns more gold than any other company in America. There's gold in them, their iPhones. Why they cost $1,000. One of the reasons. So let's switch over from this little talk over to the cryptocurrency again, which somebody asks about. I use Coinbase and Robinhood for my cryptocurrency. And the reason I use Robinhood is because I don't have to screw around with a purse. So this weekend, I will put that article up about how and why to own cryptocurrency in general. And I'll write separate articles about Bitcoin and Ethereum because those are the two that I think you should own from the right price. Last summer, when Bitcoin was under 10,000 and all the way up to it got to about 14,000, I was telling everybody to buy it. Take a few percent of your savings, not your investment portfolios. Take a few percent of your savings, buy cryptocurrencies, Bitcoin and Ethereum, for different reasons, so that you're hedging your savings. Don't trade the grayscale trust because the expenses are high, except when there's a huge discount. And right now there is. Theoretically, if you wanted to trade a little grayscale Bitcoin trust, you could. Because probably when they introduce the ETFs and that converts to an ETF, that discount will close. And this presumes that the financial industry gets what it wants, and it usually does. Talked about that in the interview with Dr. Smith, and we'll get a pop on Bitcoin. But we know that about 80% of the Bitcoin is owned by just a handful of accounts, 1 or 2% of the accounts. So as those purses cash in, who's to say that Tesla hasn't been selling out and hasn't been a big part of this correction? Because Elon Musk has a broken heart with the Bitcoin people. After the spike, you need to get out of Bitcoin because it probably has a prolonged down period. Because really, it's a digital commodity that is going to rely on people using it as a store of wealth. If you think that the sophisticated big buyers don't understand this, you're wrong. They're going to cash out on the retail herd getting in once there's ETFs. So if you want to buy Bitcoin, buy it before there are ETFs, but only for a few percent, because they might not do the ETFs. The Securities and Exchange Commission does what I think it should do. The Treasury does what I think it should do, which is not have Bitcoin ETFs. Then price is probably going to come down to that 20 to 30,000 range, which I pointed out several months ago. So understand your markets, why things do things. Why are there a bunch of big-time rich guys talking about Bitcoin? Some of them are ideologues. Most of them are just greedy. The best cryptocurrency is the one that you can use for other functions. Is it a unit of account? Can it be used as a medium of exchange? Ethereum gets used for contracts, medium of exchange, contractual medium of exchange. Probably still not going to buy your pizza with it, but if you want to own an NFT, non-fungible token, which is essentially a partial share of ownership of some asset, they track, kind of like a title tracking, right? Using a blockchain on the Ethereum platform, on the Ether platform. And then they can do the transactions in Ethereum, and then you convert your Ethereum into dollars or yen or whatever. So Ethereum is contractual in nature. It has applications that Bitcoin doesn't. That's how it was designed. You're already seeing Ethereum get used in a lot of different things. Trading energy, the NFTs, Major League Baseball cut a deal, and all the transactions for those NFTs, right, partial ownership of Major League Baseball assets, are being done on the Ethereum blockchain. So to me, Bitcoin is a trade on the idea that there will be ETFs. Even though I don't think there should be ETFs, I think there will be, because when was the consumer ever the number one consideration for the financial industry? You'll get a whole bunch of people who buy the Bitcoin ETF because it's going up. It'll pile in, and it'll spike, and your job is to sell it to the greater fools. So you get in now over the next month or two. Hope that Elon Musk does something dumb, right? And sells all his Bitcoin and drives it down into the 20s, between 20 and 30,000. There's huge support around 20,000. So as close as you can get Bitcoin to 20,000, that's pretty much where you want to try to get it. I don't know if it'll get that low. I'm talking to one of the better traders I've ever talked to right now about becoming a partner on fundamental trends. to help run this chat room using swing trades, build position trades, which is essentially what we've been doing. If you bought anything that, like here, if you had bought, let's change this to a daily chart. If you had bought this right around 32, 33 and thought of it as a short-term position, a month or two, right? You could have wrote it to 38. There you go. There's your swing trade. I preferred to use the swing trade because I think it's going to go higher. So the same methodology for building a swing trade is what I use for building positions. I would like for my positions to go up pretty quickly, right? So then people don't get mad at me. And I make more money. And you make more money. And that's what we're trying to do. So anyway, the Bitcoin and the Ethereum trades are pretty simple. I want to buy Ethereum on a correction. I've already started to scale into it. Like I said, I accidentally bought it at 2,000 on that day that it crashed because when it was close to 4,000, I said I think those will come down around 50%. I put a low ball offer in at 2,000 and went down to 1966. I woke up one morning and owned it. I sold it, not all of it. I sold most of it the other day, 2,700. I got another order in. I'm doing that at Robinhood. So like I said, I'll send you the link to do that. Bitcoin, like I said, I just think that's a trade. If they do ETFs, Bitcoin's going to go through the roof short term. But then it'll have to come back. Easy enough. Are there any other questions? Let's see here. Somebody asked about the Fed balance sheet, said, why does it have to be fixed? Theoretically, right, and this is where Immanuel Kant comes in, theory versus practice, right? Theory and practice. In theory, this debt has to get paid off at some point. In theory, they're never going to make $8 trillion on the interest of these investments because some of the counterparties, corporations in particular, maybe some municipalities, are going to have a problem. They just announced that they're going to wind down the corporate bond buying facility. And I'm going to write about that next week or the week after. Because what season are they opening up? What's going to start getting hunted now that Federal Reserve isn't supporting the corporate bond market so much? Zombie companies. Zombie hunting season is almost open. Scary. And that's one of the reasons the big indexes probably chop along for a while, because there's so many zombies in the S&P 500. Almost none in QQQ. Might be none, but almost none in QQQ probably. As I've said, there's between 100 and 200 zombies on the S&P 500. Companies that have so much debt with so little growth or no growth or in decline already that they'll never be able to pay it off. So in theory, this has to be paid off. I believe at some point, though, that instead of paying it off with new debt, at some point, they magically make it go away. At some point, the dollar gets so strong, right? Because just like with Japan, nobody pays attention. At some point, we just print the money and pay it to ourselves. You know why we can do that? Because we're the United States. So when Russia says that they're reducing the amount of dollars in their system, they're stupid. What has Warren Buffett said over and over again? Bad idea to bet against the United States. Not really sure I understand your question, Oscar. Inflation or too much stimulus money creating demand shock across pretty much every consumer sector? No, that's just not true. Demand's not any higher now than it was 2 years ago. Supply chains are moving. That'll take some time. That's all that's going on. What was one of the things I said a year ago? That the opportunity for small business, opening a small business, was going to be off the charts for the next several years. Cheap real estate and holes in the supply chain that need to be filled. And baby boomers who retired in the last year, they said they hung it up. They collected their benefits and they hung it up. One of the reasons why I really like the small cap space right now that's beat to heck. Small caps are almost value priced across the board. That's where the big opportunity is right now, small caps. And some of these SPACs that have announced deals, you evaluate the business and you say, okay, do I like it? And you know, we're investing in one that's currently a monopoly and it'll be part of an oligopoly. What oligopoly have we done very well on? Nutrien. I explained to you that oligopolies eventually regain any pricing power that they lose in the short term. And Nutrien's gone up, what, 30, 40% in the last year or two? Plus big fat dividend, now they're buying back shares. And climate change is just going to keep making what they do more valuable. That'll be the thing that I'll leave you with here today. And we're going to do a whole seminar on it. Special report, everything. If your portfolio does not reflect climate change as a reality that is accelerating, and it doesn't matter why, it doesn't matter if it's sunspots or the not really aliens from the UFOs or volcanic activity or man or cow farts or whatever. It doesn't matter why climate change is happening. We know that we have to try to slow it down, and we know that we're not going to be able to slow it down fast enough. So when they talk about 20-foot seawalls in Miami, which is what the U.S. Army Corps of Engineers just recommended, a 20-foot seawall, not out in the water, but inland, basically sacrificing part of Miami to the ocean, you need to wake up. Now, the reason they put it at inland is because it's only a $6 billion project if they build it inland. I categorically guarantee you that they're going to move it out into the water and triple or quadruple the cost. And we also know that climate change migration has already started. CIA talks about it, the Pentagon talks about it. It's not me, it's not CNN, it's not the New York Times. It's the Pentagon and the CIA. So when intelligence from all different directions is saying the same thing, all they want to listen. Because sometimes the experts are actually experts. And that's something that we've lost, listening to experts, real experts, not the bought and paid for type, just the people who try to be right for the sake of being right. So take a look at your portfolios. Start with step one. If you own businesses that are in secular decline, find a way to get rid of them. Sell the RIPs. And ultimately, the government and the Federal Reserve are just changing the timelines a little bit because they're political. The Fed shouldn't be political, but it is. It's also basically, right, the banking sector. You've already heard Jamie Dimon and Ray Dalio and a bunch of other ones say they don't want to own treasury bonds anymore. Why? Not a philosophical thing. They own those bonds for 40 years. They're just not getting paid enough now. And those guys are all about the money. At some point, interest rates will go up. But in the short run, the next several years, it won't be much. Whenever they bail out the retirement system, that's when interest rates go up. The nearest term I've seen on that is 2026. And the latest I've seen is 2035. So sometime between 2026 and 2035, they'll bail out the retirement system. All right, I will put out the crypto articles. We're going to do the clean energy thesis a little bit more clearly. Technology is still king. So there you go. That was the Q&A brain dump this week. Thank you very much. And please meet me in Vegas. I hope that you can come out and we'll do another Q&A. And we'll talk about our kids and grandkids and, you know, all the stuff that life should be. All right. Have a great day.